I guess today what I'd like to do is to give a bit of a quick overview of where I see the economy and the corporate sector being at, looking through the prism of the interim reporting season that we've just been through, and I guess explaining why I think we need sales heroes at this time. We're at a really important or interesting juncture in the economy. And I think the one word that I would use to describe the way most people are feeling is fragile. I don't think we should underestimate the psychological impact of the GFC. It is sort of 6 years ago since Lehman Brothers went over, but it was a sort of shock that it does take an economy and a society some time to come back from. If you remember back to 2006, 2007, life was pretty good, credit was easy, the interest-free loans were everywhere, we were fixated on filling our houses with stuff, and we got really good at that. And then this sort of global shock happened and we went right back into our shells. And if you think about how society is now, we're quite different from an economic point of view anyway. We're great savers now. We suddenly put more money into our mortgages than we need to. We value experiences more than goods. You haven't seen the spending on travel, for instance, fall off, but you've seen the spending in retail fall. So we're choosing where we put our money and rethinking what's important to us. So those psychological changes, I guess, are understandable from the point of view of society, but I don't think they make it any easier for business people. I want to have a look at what's happened in terms of business conditions, business confidence and consumer confidence. Business conditions, and this is from the NAB's research, a function of trading conditions, profitability, cash flow, the sort of hard data that comes out of the business. And you can see from there it's been a pretty average type of picture for most of the last few years, and this is only going back from 2011, so it's pretty recent history. We've been below that zero line, and then you can see towards the end of the graph we jump up. Someone coming by chopper, Sue? No? We jump up towards the end of last year when it appeared things were getting better, and then there's a noticeable dip at the end of this year, which is a bit of a concern. It's a similar sort of picture with business confidence. There's a lot more ups and downs. Managers and entrepreneurs have been at various times over the last 2 years, 3 years, perhaps more enthusiastic than they had reason to be. I think there's a natural optimism that entrepreneurs and managers have. They think things are going to get better. They tell themselves that. They tell their staffs that. And even though business conditions have lagged, there are a few big jumps up in confidence. You can see one in the middle of last year, but again, since then, confidence has really come up, despite the fact that economic conditions are still pretty solid. They're definitely improving around the world, and we haven't seen anything like interest rate rises or any movement in that sort of area. Conditions are getting better, but we're not feeling it. That's the sort of up and down roller coaster nature is even more noticeable when you look at consumer confidence over the last 10 years. That line you can see in the middle is basically the depths of the GFC, and since then things have been absolutely up and down. Confidence tends to go up when we see interest rates fall and we get a better sense of the domestic economy, but confidence has been weighed on by things like Greece and the troubles in Europe. It's also been weighed on more recently by elections. And we see again a really sharp, noticeable drop at the end of the period there. So in the first quarter of this year, we've again seen this drop off. So what's behind the fragility? I think it's this. That's a bit of a dramatic picture, but I guess what I'm trying to say is that job security is always the biggest driver of consumer confidence, and despite the fact that things are pretty good, there's a lot of consumers out there fearing this. It's hard to understand because the fundamentals are really quite good. Interest rates at record lows, unemployment at 6%, and given that we sort of think of full employment at around 5%. We're not that far off it, so it's a pretty good picture in terms of the jobs market. We're 23 months ahead on our mortgages, so we've done a lot of good work increasing our mortgage payments, or more to the point, leaving them stable as interest rates have fallen. House prices are rising, and that generates a bit of that wealth effect that tends to propel the economy along. And we tend to forget this, particularly in the sort of political noise, but the Australian economy has been growing for 23 straight years. And as plenty of politicians will tell you, that's a record that's enviable around the world. They'd kill for something like that in Europe or North America. But, you won't get, you still have people thinking of those breadlines, which is a very strange thing. But I think that consumers are actually pretty switched on. And what they're seeing is a sort of grassroots or a operational level. Consumers are also workers, and they are seeing what's going on inside their companies, and that's informing the way they're thinking about the wider economy. And I think we can get a better sense of that through the picture of the interim reporting season. So I'm sure you guys know this, but twice a year, all ASX listed companies are required to report their results to the market and tell investors how they're travelling. Even if you're in an ASX company, it's a great chance to see how your business and other businesses are performing. But even if you're not in an ASX company, it's well worth looking out for similar businesses or businesses in your industry to get a sense of how they're travelling in terms of margins and sales and all that sort of thing. So it was a pretty good interim reporting season, a pretty positive picture again. This is some research from Craig James, who's the chief economist at CommSec, and he looked at 138 companies that reported during the half-yearly reporting season. 65% of these had increased profits, and that was the best result since 2009, 2010. So, a real sense that we're over that GFC hump. In total, we saw profits up 19% to 365 billion. Now that tends to get skewed by some of the big companies, BHP Billiton, some of the banks, Wesfarmers, those really big conglomerates. Take out those guys and the profits were still up 32.9%. It's a pretty positive picture, and it would tend to suggest that the corporate sector of the economy is travelling pretty well. There's two other things that I think are really important and inform some of the trends that we're seeing. 50 of those 130 companies lifted their cash holdings. And they didn't just lift them a little bit, they're really socking away the cash for a rainier day. 35% the cash holdings went up to $87 billion. That's a lot of money sitting there ready to do something with. But what companies are doing with it is in part giving it back to their shareholders. So 76 of those 138 companies lifted their dividends, aggregate dividends up by 7.2%. So companies are either doing two things, or in some cases they're doing both. They're hoarding cash or they're giving it back to their shareholders. And I think the important thing there is what aren't they doing with their cash? But I'll get to that in a minute. Overall, a pretty good picture. It's hard to be too negative about the corporate reporting season, but there is a big but, and that but is the fact that every CEO, to a man and woman, was pretty cautious about the outlook, describing a very short-term market. 1 month's good, 1 month's bad. Things are okay in this geography, but they're not great in that geography. A lot of investment decisions being put off or held back. That caution is still very much a part of the corporate landscape. And I think that's what consumers are picking up on. They hear this from their CEOs or their managers. Things aren't great, things aren't terrific at the moment. Hopefully it will improve in the second half or the next quarter, but at the moment we're pretty cautious about life. So if CEOs are cautious, how did they produce those fantastic results? Big scissors. The answer is cutting back on jobs, cutting back on offices, cutting back on investment, cutting back on some products. A lot of the results we saw, I would say 95% of the results I saw, there was explicit mention of the cost control and the way that had been used to not prop up the profit, but certainly profits were pushed along by a lot of cost cutting. And so to me, there's two trends going on here. On the one hand, we've got profit being driven by cost cutting, and on the other hand, we've got cash either being hoarded or given back to shareholders. Now, I think there's two things driving that. The first is the fragility of the business sector. Companies are doing the right thing. They can't see more than 3, 4, 5 months out, so they're keeping something in reserve. They're not getting too excited about the future. They're keeping their cost base low and hoping for the pickup. But there's another factor that's quite important in the second trend of hoarding cash and increasing dividends, and that's these guys. Our grandparents, or my grandparents maybe, your grandparents, your parents, spending your inheritance. And fair enough too. They're living large and enjoying themselves. We have this growing, obviously superannuation pool, but we have this growing number of do-it-yourself super funds. So people who have decided to take control of their own super, they're running a self-managed super fund, and they're very particular about the sorts of companies they invest in. When they invest in an ASX listed company, what they're looking for is yield. They're looking for income that they can use in their retirement to enjoy their boats and their trips and their spoiling their grandchildren and all that sort of thing. So companies have to respond to that, and they are responding to that. And they're responding to that by being generous about the dividends that they pay, in the hope that they appease the self-managed super fund investors that they've got on board now, and hopefully, for their sake, attract more self-managed super funds and push their share price up. So these guys are really changing the market. They're 30% of all superannuation accounts at the moment. That'll probably go to 50% over the next decade or so, and that's having a really marked effect on the way these companies are being run. They are increasingly paying bigger dividends, or they are hoarding their cash so they can do that in the future. But I think there's a big concern there, and that's if you hoard your cash or you pay it out as dividends, you're not using it for other things. You're not thinking about the future. If companies hoard cash or pay it out and increase dividends today, what's their business going to look like in 5 years or 10 years? Are they going to be able to invest in the new products or the new offices or the new geographies that they need to get into to keep growing that business and keep building it up so they can continue to pay bigger dividends in the future? Yes, clearly companies need to cut their cloth to suit their market, and that's what we're seeing them do. They do need to cut back and be cautious when it's called for, but no company ever really cut its way to growth or saved its cash and got to growth. And again, what's the landscape going to look in 10 years? Sure, these self-managed super funds and fund managers are pleased to see increased dividends now, but how are they going to feel in 10 years when the investment hasn't been made and the ability to keep paying those dividends is lessened? Now, hopefully I'm wrong, but there are some worrying signs. This is some information from the ABS that was released in the last month or so. The first estimate for investment by companies in 2014-2015, so that's next financial year, was down by 17.4% on the previous year, and that's the biggest fall on record. So we are seeing companies make decisions about where their money goes, and they are deciding that they're not going to invest in the future at the moment. Hopefully that's cyclical, hopefully it's short term, hopefully the numbers that companies are putting out there don't turn out to be as bad as they think. But I've got a sense that while companies are focused on hoarding cash and paying out dividends, there is a concern that investment will become a sort of second order issue. And to me, this is why we need sales superheroes, and Peter can talk about turning you into those if you're not already. We do need salespeople to be out there driving their businesses forward, bringing in the extra revenue and creating the extra resources such that companies can invest in the future. It is difficult to cut your way to growth, but increasing revenue and improving your sales performance does provide extra resources that can be invested in new products and new geographies, new markets. We're at an interesting time in the Australian economy. We're trying to manage this transition away from mining, where there's not much sales involved at all, to more of a services-led, broader-based economy. That's going to be very hard if we keep keep focusing on cost cutting and not enough on investing. So I hope you guys can improve our sales performance across the economy, start getting those extra resources in, and we can start investing in the future of not only our companies, but I guess the wider economy too. So thank you very much. That's my Twitter handle. It's been a real pleasure to come here this morning, and I'd now like to hand it back to Sue. Thanks, guys.